Understanding the Cash Flow Worksheet. Hello, my name is Angela. I have been working with Caseware as a consultant on IFRS and SME content for over 13 years. I absolutely love IFRS training and anything that is related to it, and so I'm very excited to be on this short journey through Caseware's Cash Flow Worksheet with you. What is the objective of this video? In the 2022 release, a new cash flow worksheet was added to the IFRS and SME template. This worksheet is integrated into the statements of cash flows, and consequently some changes were made to the statements of cash flows itself. My objective is to demonstrate the relationship between the worksheet and the actual cash flow statement in the financial statements. I will do this by means of a very short explanation, followed by a demonstration. To set the background on the reasons behind creating the cash flow worksheet in the first place, I refer you to the requirements of IAS 7 and Section 7 of the IFRS for SME. Paragraph 43 of IAS 7 reads as follows: investing and financing activities that do not require the use of cash or cash equivalents shall be excluded from a statement of cash flows. Paragraph 718 of IFRS for SME is very similar. So both versions are very clear that transactions that do not require the use of cash or cash equivalents must be excluded from the statement of cash flows. This literally means that non-cash transactions should not be in there. They should be stripped out so that only cash transactions are presented. Regulators such as IRBA and the JSE often report on misstatements in financial statements because of the inclusion of non-cash transactions in the statements of cash flows. So compliance with accounting standards has always been of utmost importance to Caseware, and in response to this market problem, a project was launched to add a workpaper tool that could be applied by users to assist them in removing these non-cash items in a visible and an auditable manner. Now this slide is very important to take note of. The cash flow worksheet is completely integrated with the financial statements, and it will not be possible to complete the statement of cash flows without it. Before we launch into the demo, I would like to explain how it all fits together. The cash flow worksheet is document 0170 on the document manager. The worksheet is made up of 5 components. The first part is a cash flow worksheet or the non-cash movements workpaper. It could also be considered as a statement of financial position workpaper because it is set up in the format of a statement of financial position. In this part of the workpaper, all the non-cash movements are stripped out on a line-by-line basis to retain only the cash movements for each line item on the statement of financial position. This section is followed by the operating, investing, and financing activities workpapers respectively. The output of the first part of the worksheet, being the pure cash flow movements per line item, is pulled through to these workpapers. It is here that the cash flow movements are properly allocated to the type of cash flow. So for example, the full cash movement on property, plant and equipment is calculated in the non-cash movements workpaper. This is then pulled into the investing activities workpaper, where it is correctly allocated between cash purchases of PPE and proceeds from disposal of PPE. The totals of operating, investing and financing activities workpapers are then compared in a test of cash flow to ensure that the statement of cash flows is in balance. The amounts allocated in the operating, financing and investing activities workpapers then pull through to the actual cash flow statement and notes in the financial statements. This is the only way to bring values onto the financial statements. Now I know that you're very eager to get into it and are planning to practice some cash flow statements with friends this evening. So without any further delay, let us take a look at a demonstration. I am using the SME template for my demonstration, but the principles are exactly the same in the full IFRS. Okay, so I've imported my trial balance, and of course very important to note is that you have to make sure that your trial balance is properly mapped. Secondly, before you attempt your cash flow statement, please make sure that you've completed the other notes throughout the financial statements, particularly those with reconciliations, for example, property, plant and equipment. So you'll want to make sure that your recons are fully completed. The reason being is that the cash flow worksheet doesn't only use the trial balance to make calculations, but it actually pulls information through from various other notes within the financial statements. Okay, let's go take a look at our cash flow. So when you open your file, if it's a new file, which mine is, you will notice that the comparative period for the cash flow statement is actually blank. I have gone ahead and updated it by typing in the values in accordance with my signed financial statements from the prior year. This manual process is only required for new files because going forward, your comparative figures will always roll forward in the year-end procedure in the roll forward. So it's literally just for the first year. Okay, if we look at the current year column, you will see two buttons. We've got the first button, which is a link directly to the cash flow worksheet, and underneath that is a refresh. So you're just going to click on this refresh from time to time during the process because it's literally just updates from the worksheet and into the financial statements. So you'll want to do this first time when you prepare your cash flow statements. So let's go ahead and click it and see what happens. And it's going to bring through all the values from the worksheet in a moment. And there you go. And you'll also notice that the out of balance portion is significantly reduced, and that's probably because of a non-cash flow item which has to be dealt with. Okay, let's go through to the cash flow worksheet. In the cash flow worksheet, you will notice a document map on the top left-hand corner. Mine only shows for company, but if I had activated group mode, I would have this entire section for group and then separately for company, and then obviously each section pulls through to the relevant cash flow statement on the financial statements as either group or company. So let's take a look at the overall layout of the document. First of all, cash flow worksheet company. If we click on here, it's going to take us through to the main body of the cash flow worksheet. And this is also called the non-cash movements workpaper. You will see that it consists of some grey text in the beginning, which is just extra guidance to explain how the document works. This is the part of the document, as I've said, where you're going to remove your non-cash flow items. How it looks is it's set up in the structure of a balance sheet or a statement of financial position. And you're going to have the asset section first, which is followed then by equity and all of the liabilities, as you can see. How it works is that we start off with the opening balances for every line item on the statement of financial position. Then we put through in the next few columns, just by their different natures, all of the types of non-cash flow items. Some of them are going to be automated and some of them are going to require a manual input. This is because not every type of non-cash flow item can be identified directly from the trial balance or from the other notes. You would notice that up until now we have not input anything manually, so everything that you see before you at this point in time has been automated from the rest of the financial statements. So like I've said, this section takes the opening balance, all of the non-cash movements. It then subtracts the closing balance for each line item to arrive at a calculated amount with being the net cash outflows or inflows for each line item on the statement of financial position. So this is done for literally the entire statement of financial position, and at the end of the process there is a small little balance check just to make sure that we have accounted for all of our cash flows. The idea here is to take all of the movements to assets, equity and liabilities, compare those cash movements to the movement to cash equivalents, and obviously the answer there should be 0. If you see that it is not 0, as is our case here, we have a 500,000 difference, it simply means that we have not taken the double entry into account in our non-cash movements, or we have incorrectly mapped somewhere. So in our case, we will see that through the automatic system, there was a transfer of property, plant and equipment of 500,000. So this is the amount by which we are out. There isn't another transfer of the other side of the 500,000 that has been recorded yet. This would have to be done manually. So I would just tell you that because I know the transactions, this was actually a transfer from inventories to property, plant and equipment. And of course, property, plant and equipment has got a reconciliation of movement, and from that reconciliation of movement, we obtained this amount. But there is not a similar reconciliation of movement for inventories. So there was no way for the software to know that there was a 500,000 transfer from inventories. And so in this is the kind of process that we'll follow to go and make the additional non-cash flow movements, ensuring that both sides of the transaction are captured. The other side of the non-cash transaction in, and then we would see that our first part of our worksheet is actually in balance. I am going to come back and look through other of the specific transactions, and I'll explain the specific transactions in a bit. I just want to first show you how the whole document fits together. Okay, so part one of the cash flow worksheet is literally to take out your non-cash movements like transfers to or from property, plant and equipment to create or to result in only the net cash flow movements. From this document, all of these cash flow movements have to go somewhere. And so they land up in either the operating, investing or financing activities working paper, depending what is appropriate. So our assets, obviously, except for our working capital assets, will go through to the investing activities working paper. I'll show you what I mean. So if we go and click on our investing activities working paper, there we're going to see in the default cash flows column all of those amounts of cash flows which were calculated in the main cash flow worksheet. Now the purpose of the operating, investing and financing activities work paper is to take these cash flow amounts that were calculated in the first part and to just reclassify them or to classify them by nature to the correct nature of that type of cash flow, and then the final output is then pulled through to the statement of cash flows. So we saw, if I go back to the main cash flow worksheet, if you follow me, we said thus far we had a cash outflow of 2,070,000 on property, plant and equipment. That full amount is taken to investing activities. And here in investing activities, we assess how much of it was purchases and how much of it was proceeds. Again, some of this is automated. We'll look at the detail in a moment. But here, so in the next column, reclassification for cash flow line items, we now classify this 2 million to the purchases and the proceeds. And by allocating how much of it belongs to proceeds, the equal and opposite amount is subtracted from the purchases line to retain a remaining purchases amount. And then we also are left with the amount that was for proceeds. And this allocation process goes on through all the different various categories. The same follows for, if we go back to our worksheet, our main worksheet, and we go to equity and liabilities. Here we can see some equity. We see a share capital. If we go to our net cash flows, we see there was actually a 2 million rand inflow. If we move down to our liabilities section, we'll see some liabilities here like loans from group companies, 700,000, and a few other liabilities. Those amounts all pull through to our financing activities work paper. Do you see them? Again, our share capital, our 2 million rand, you recognize that amount. There's our loans from group companies, 700,000 rand. What we would have to do in the financing activities is just do any possible reclassifications which are necessary to the nature of the cash flow. And then After our reclassification, our final cash flow amount by nature is then taken through to the face of the statement of cash flows. I just want to show you the last one, the operating activities. So in our main cash flow worksheet, we will then go to the equity and liabilities, where we will find the retained income section, which obviously our movement for retained income for the year, what is the majority of that movement? Yes, it is profit or loss. And this line is actually split out on our main worksheet. So all of our profit or loss adjustments, things like depreciation, profit or loss on disposal, and so forth, all of these are split out separately in the main cash flow worksheet. And these items are dividends, interest, taxation, those numbers all pull through to our operating activities working paper, where they are just also correctly allocated between cash from customers and cash paid to suppliers and employees. Also in the operating activity section, I'm just scrolling down, you would see the interest, dividends, finance cost, taxation, and so on. These would have been obtained also from that section of the worksheet above. Let me just show you. There's 120,000 for dividends. This pulls through from the main worksheet. Scroll down to the equity section. Scroll down to dividends received. There it is, the 120,000 Rand. Also part of the operating activities section would be our movement in working capital. If I stop here, changes in working capital. These are obviously assets and liabilities, and where would we find these? These would have come from the various asset and liability sections in the main worksheet. Keep an eye on inventories and trade receivables. Look at the numbers, 1.58 million and 360,000. If we go up to our main worksheet and we go and find our inventories, there it is, 1.58 million. Trade and other receivables, 360,000. The same will be true of trade and other payables, 2.1 million inflow. Let's go find it in operating activities. And there our trade and other payables is in our operating activity section. So this is just to show you how the main worksheet pulls through to the operating, investing, and financing activities work paper, and how in these work papers, more specifically in the investing and financing activity sections, reclassifications are made to the full identified cash flow per type of asset or liability, just to get the split out into the type of cash flow. And then finally, each of these movements go through to the cash flow statement and the note. And I will just show you these property, plant and equipment at this stage as an example. If we move to, there we go, property, plant and equipment, you will see those values have pulled through. And you'll also notice that I can't make any adjustments on the face. And the reason for this is because we don't want to damage the integrity of the worksheet. Your changes can only be made in the worksheet itself. What I would also show you is that if you go into the worksheet, let's just go to we're in investing activities, the reclassification section. If we look at a number like, I'm going to pick this one here, loans to group companies, just because I'm standing on it. If we go and decide that this amount of 3.8 million, it's defaulted to cash receipts on repayments of loans to group companies. If we decide that this was not actually a cash receipt on repayments of loans, but it was actually an advance of loans, we would make an adjustment here. So let's say that we know from our knowledge of business that 7 million was advanced to group companies. And that would mean that it doesn't change the fact that our full cash flow is 3.8 million. So if we going to say that 7 million was actually an amount that was advanced in loans to group companies, this same 7 million is going to come off in the opposite direction as a positive 7 million agreed, against the cash receipts on repayments of loans to group companies to add to a total of 10 million must have been received. How do I get that? Well, if our total cash flow related to group company loans was 3.8 million inflow, and I know that 7 million was the amount advanced as an outflow, it meant that 10.8 million must have been received back, because the entire amount has to be agreed or has to be in agreement with the full amount that was calculated in the main worksheet. So in this way, there's no manipulation possible. The full amount of your cash flow movement will always remain 3.8 million. And of course, let's go see the 7 and the 10.8 we should find on the face of our financial statements. And there they are, your 7 and your 10.8 million. So I am just going to correct that for now because that was just to show you the point. The final part of the cash flow worksheet is this test of cash flow. What the test of cash flow does, I've jumped to it, is it takes the total cash movement for the year, which is calculated as the sum of each of financing and investing and the operating activities tables. It adds them all together and compares them to the opening balance for cash and cash equivalents. It also includes if there were any foreign exchange gains or losses on actually cash or cash equivalents, takes that into account, and then it subtracts the closing balance for cash and cash equivalents, and the outcome or the answer must be 0. So this is not the final note. This is just a test. If this is 0, it means that our cash flow statement will be in balance. However, I just want to point out that simply because it is in balance doesn't mean that it is correct. Up till now, I've only showed you how this worksheet pulls together, but we haven't made any adjustments at this stage. Everything that you have seen, apart from this 500,000 Rand that I showed you to balance the inventories, or for inventories to balance the cash flow worksheet, everything has been automated. But we've not yet gone through a process to find out if there weren't perhaps any items or any other non-cash flow items which need to be adjusted here. I also haven't gone through the process yet of explaining to you how this portion of the worksheet works. So let's take a look at that detail. I'm now going to go through every line item on my cash flow worksheet to identify whether there are any non-cash flow items. Just as a starting point, before I actually climb into property, plant and equipment, every non-cash flow item has to be recognized in this table or recorded in this table in the direction that it affects the line item associated. So, for example, we know that there were transfers to property, plant and equipment of 500,000, which were obtained directly from the reconciliation of movement table. And because it was a transfer to property, plant and equipment, it meant that it was a positive or a debit, and so it gets included in this table in this direction. So what the user would have to do is actually, now we're dealing with property, plant and equipment, the user needs to identify whether there were any specific non-cash movements related to this line item, apart from those which have been captured. So what we do see here, before we go to look at any manual adjustments, is, like I've said, the transfers and reclassifications came from the reconciliation. If we just go to our property, plant and equipment note, we will see there was transfers of 500,000 in, which pulled through to our worksheet. I just want to show you quickly that if we override this value, it's going to give us an override indicator, as expected. Right, so this pulls through from the work paper, from the reconciliation. What we also see is in the column called non-cash through profit or loss, we are actually going to see that the software is able to determine non-cash flow items which affect our assets and liabilities through profit or loss. Things like depreciation, impairment, profit or loss on disposal, they will all come through to this line. And just to tell you what we can expect here, there was depreciation of 650,000, which you can see in the reconciliation. And in addition to the depreciation, you can tell that you see there was a disposal of 100,000. I can tell you that there was a 30,000 profit on disposal. So the 650 depreciation and the profit of 30,000 all come to this cell to give a negative amount of 620,000, which was the net effect on property, plant and equipment. And those are all non-cash flow items. The other side of this non-cash flow transaction, you will find if I scroll down to our retained income. Remember, our movement in retained income is predominantly net profit. So in our cash flow worksheet, our net profit movement goes to the retained income. And I've told you previously that it splits out. So there's the other side of the depreciation. What was it in retained income? It was a debit, so we're going to show it as a positive here because debits are positive. Then we see there's our 30,000 Rand profit or loss on disposal, in case you thought I was lying. And this is a credit to net profit, so it's shown as a credit here or a negative. But when it was the other side of the transaction, of the non-cash transaction, is showing in property, plant and equipment, it was a debit. Now I know that profit on disposal didn't actually hit the property, plant and equipment line item per se, but it is taken into account in calculating the total cash movement for property, plant and equipment, and so it is included in this cell. So far, just through the automation process, it appears that we have 2 million Rand odd cash outflows associated to property, plant and equipment, but let us just go to the financial statements to just make sure that there isn't perhaps another non-cash movement. In our scenario, we see that there are additions of 2.2 million. The user needs to work out whether any of that was a non-cash addition, perhaps through leasing. And in this case, we have worked out that in fact the full 2.2 million was through leasing. This is not a cash movement on acquisition, so we have to put that adjustment through our cash flow worksheet. So we're going to then go and put the 2.2 million into the assets in the non-cash capital additions column. And immediately what's going to happen is, because we've always got to have both sides of the transaction, you will see that we are out of balance. So the other side of that non-cash transaction was against lease liabilities. And we are back in balance. So the user is going to go through every line item following this process and accounting for all non-cash transactions in these yellow cells. So finally, if I just finalize what I've been doing at property, plant and equipment, our opening balance came from the trial balance. We've taken all of the non-cash movements into account. We subtract our closing balance and we're left only with a cash inflow of 130,000 Rand, which I expect to be the proceeds on disposal, because you'll remember that our disposals carrying amount was, if I go back, was 100,000, and you remember that there was a 30,000 Rand profit. So let's just see how this plays out. The full cash flow pulls through to the investing activities section, and every type of asset has a default cash flow. So for property, plant and equipment, our default cash flow, the full amount goes to purchases. Here we have to reallocate how much of those purchases were actually proceeds on disposal. Like I've said, and that goes into the yellow cell, the proceeds and disposal is possible for the software to calculate by taking the carrying amount of disposals and adding to that profit on disposal. So the reclassification takes place so that the full amount sits in proceeds only. And this amount of proceeds is then automatically transferred to our cash flow statement. In investing activities, only 130,000 Rand proceeds from sale of PPE. Let's go back to our worksheet and back to the main section. You will then look through each of the line items which have values. And the next one that we have is our loans to group companies. I'd like to mention at this point, this is a question that often comes up. Because loans to group companies can change year on year, loan to group company could change and become a loan from group company. And the movement should not be accounted for only as financing or only as investing activities. To the extent that the loans are loans receivable, the movement needs to be accounted for as an investing activity, and to the extent that it is a loan payable, it needs to be accounted for as a financing activity. So I just want to show you how this is affected and how the software makes sure that this happens correctly. I just would take us back to the financial statement so that we can see what our group loan situation looks like. So loans to group companies, let's go to the note. In the prior year, it was a receivable, so an asset, and in the current year, it's a liability of 700,000. If we go to our worksheet and we go to our worksheet section and we look at our assets, we see our loans to group company. As expected, our opening balance is the 3.8 million. Let us say that there were no non-cash movements. We're happy with that. Our closing balance is 0, so we minus 0. We've got a 3.8 million inflow on loans to group companies, which means that the group companies have repaid us. We expect to find this in investing activities. Let's go and see. So in investing activities, we see cash receipts on repayments of loans to group companies. This is the correct classification. So we're going to leave it in this default where it landed up. And the final column, 3.8 million, will go to our investing activities on the face of the cash flow. Let's go and see what happened to the liability side of this loan. If we scroll all the way down to equity and liabilities, keep going to liabilities, there's our loan from group company. Do you agree our opening balance of the loan from is 0? And our closing balance was 700,000. Remember that it is a credit balance, but we are less closing balance, so we're subtracting a credit balance. So if you minus a minus, it's a positive. So, which means that our net cash outflow, starting from opening balance, no non-cash movements, plus the 700,000 closing balance, gives us a 700,000 cash inflow again, which meant that this is a loan from group company. We have received the money. It means that the holding company has advanced money to us. So let's go to financing activities. There's the 700,000, but it's defaulted to repayments of loans from group companies. I have typed the correction in here. So it should be cash advances received on loans from group companies. So I've just reallocated it to this line, and you can see that it's correctly shown only as the advances received from group companies, 700,000 in financing activities. And once again, all of this pulls through to the face of the cash flow. There we go, investing activities. There's our loans to group companies and financing activities. There's our loans from group companies. So in this manner, the preparer of the financial statements is going to have to go through each of the line items in the assets, liabilities, and equity section. I just want to show you some other examples here. For example, deferred tax is included because deferred tax is a line item on the statement of financial position, but we do expect it to be 0, which it is, because it's taken the opening and closing balances being our balance sheet line items for deferred tax, and the amount assigned through profit or loss should result in a net cash movement of 0. Looking then at trade and other receivables, our non-cash movement through profit or loss in this case was an amount of 12,000 Rand, which was a foreign exchange gain. And this is a process that you're going to have to go through for each and every one of the statement of financial position line items. it works very much the same through your equity and liabilities. We've got our equity first. I just want to show you. We have looked at some of here are our liability items. We've already taken our non-cash movement through finance leases, and in our example, there are no more adjustments necessary. I just want to take a moment to talk to the retained income or the net profit or loss section of our main worksheet. So I have said a couple of times in this video that the movement in retained income, because obviously we start with the opening balance and less our closing balance, gives us the movement for retained income, which would be net profit, unless there were other items like transfer between reserves, which you would then take out in these cells. So what we have to do is, you would know that in our cash flow statement that we have to disclose many items, or the items that we remove from profit or loss, and there is a lot of disclosure around these items required. So instead of showing all of our non-cash movements through profit or loss in a single cell in this line, we just decided to split them out. So this is why retained income looks a little different. So just what you need to picture is that this full portion, non-cash items included in profit or loss, all of these items, followed by removing items which are presented separately. Remember things like interest and dividends. So all of these items here, for your non-cash items included in profit or loss and removing of those which are presented separately, in your mind's eye, take all of these items and squash them up into the retained income line, and then you would get the same impact as for the other type of line items. So all we've done is we've just split them out. So it becomes easy for us to follow the process. So first of all, we've got the items included in profit or loss, which would always be non-cash items would be excluded, and those are our depreciations, profit or loss on disposal, foreign exchange, movements to provisions, and so forth. You see they come out automatically through non-cash through profit or loss. All of those would then move to the final column. Now I know although these are non-cash items sitting in the net cash inflow or outflow column, remember that we said it's slightly different for retained income, because with the retained income line, our total net profit sits in the last column, which means that if we, by logical inference, have got our non-cash items following after, then what would you remain if we add all them together is simply the cash portion of profit or loss. So it makes complete sense. This is predominantly going to pull through from mapping. Then we remove our interest, dividends, finance costs, taxation from profit or loss in the same manner. You can see it just pulls from mapping. Why are these removed? Because they're going to be disclosed separately on the statement of cash flows. So we take them out only to put them back in below, because this portion below where we put them back in, these are going to pull through to the section on the statement of cash flow where they're actually presented separately. And this deals with the net profit line items. Having said that, I would like to then move actually to the operating activities work paper, because it's slightly different than the investing and financing activities which we have discussed in great detail. So I'm going to go straight to the operating activities section. Now looking at the cash flow from operating activities working paper, you will notice that this is really just one large calculation. Very little work to be done here. It's just for review. So what we've done is we have just split out to obtain the net profit or loss before taxation. We have just split out all of the numbers on the statement of profit or loss and just allocated them either as cash received from customers or cash paid to suppliers and employees. but it is the total amount which eventually adds up to the net profit or loss before tax, and this is the amount that pulls through to the note. So this is just a calculation just showing you how we've done the split. Then we've got our adjustments for non-cash items. Again, all of these values come through from our main non-cash flow item worksheet. I'll show you. It's in the equity and liabilities section, and there it is, all of our non-cash flow items which pull through in the operating activities after we have done our split of net profit or loss before tax. So all of these non-cash items come from the top table, and they just go into the same category as where they were included in profit or loss. So for example, depreciation, amortization and impairment in our allocation was against cash paid to suppliers and employees. So obviously we're going to take it out in that column so that in the end there's actually no depreciation included in this final amount at the bottom at all in the cash generated from operations. Okay, so the full adjustment for non-cash items comes from the top table, and then again also from the main worksheet comes our adjustment for items which are presented separately. So there's still no work to be done, and our changes in working capital also pull through from our main worksheet. So there's actually no work to be done here. This is just showing you how the calculations were performed. So we finally get, this is where our cash generated from operations numbers arise, and you will see that they pull through to the face of the statement of cash flows, and I'll just show you where they are. So at this point, it might be that you don't want to present the cash receipts from customers or paid to suppliers or employees lines. So the way that you would avoid these is to just enter into builder mode, and I'm going to quickly do that. Right, if I go into builder mode, I can just switch the section off and then exit builder mode again. And this is because some users prefer not to show those that allocation. But the total will still agree with, if we go back to our cash flow worksheet, our total is still calculated in our cash flow worksheet. Then the next section is to just talk about these items being interest, dividends, and tax. You know that these items could be presented depending on their nature, either as operating, investing, or financing activities. What we have done in the worksheet is we have automatically allocated them by default, and you'll see there in the default other column, to the operating activities work paper. The way that you will change this allocation is to type the amount into the desired new location. So for example, dividends received could either be operating activities or it could be an investing activity. So our amount of 120,000 Rand is the correct amount which pulls through from the cash flow worksheet. So this is the ultimate amount which will be presented and cannot change. It's only the reclassification that we would do now. So let's assume that this 120,000 we wish to present in investing activities. Let's jump to the investing activities section and go to the bottom of our investing activities. You will see dividends received. There is nothing in the default because it doesn't default to here. But if we go and we then put that 120,000 in the reclassifications column to say we want to bring it to investing activities, you will see that it then presents in investing activities. If we go back up to our operating activities section, our dividends received, you'll see the default remains, but then you will notice that the 120,000 comes out in the reclassification column. So it automatically comes out or subtract it here from wherever you've put it in elsewhere, so that the total amount in the statement of cash flows in operating activities is 0. So if we go to our financial statements, you'll notice dividends received 0 in operating activities, but in investing activities, the 120,000 Rand has come through. And this same process you will follow for your interest, finance costs, and so forth. I trust that this has been a useful video, and I wish you great enjoyment in preparing your statements of cash flows. Thank you very much.